So today we're going to talk about housing market trends and what direction we think the market's going to go this year for buyers and sellers. But first we're going to talk about buyers. And I think it's important to be realistic about where we are in the economy and what's available, because the days of the 2.5% interest rate mortgages, those are over. Mm-hmm. That was an opportunity. You were either ready or took advantage or you didn't. It's not coming back, not anytime soon. And we also have a pretty good indication from the Fed that they're not going to be doing many rate reductions. In fact, they've only hinted that they'll do one next year. Now, they can say that today, but they don't have a crystal ball. They are very smart. But there might be global factors or domestic factors that incentivize them to reduce rates or increase them, and I hope that's not the case. But where we are right now today is actually very normal lending rates. It's just painful when there was 2.5% less than 2 years ago. Mm-hmm. So we have to accept that this is where we're at today, and there are some hurdles related to having enough of a down payment to qualify, because the risky loans are mostly gone. There's still some out there, but you do have to have a down payment. And the second hurdle is the pricing of houses. And we're starting to see for sale signs stay up longer, which is good for buyers, because for a while during the pandemic, you didn't even see a for sale sign. Mm-hmm. You saw sale pending. They didn't even get the sign planted. It happened that fast. It was under contract, and that's very frustrating. So as a buyer, you have more time, which is good. But one thing that people really need to be aware of is what it is that they want when they're looking at houses. As there's more inventory, is to be prepared to make an offer. And I find this to be very basic, but something that most people haven't done is to sit down and create your own house manifest list, your own dream house. What are the non-negotiables in a house that you need to have that you can say, this is my house? Is it a master bedroom on the first floor? Is it a home office space? Is it a fenced-in yard for the dog? Is it room for a nursery? Does it need a pool? Does it need a jacuzzi? What is it that's non-negotiable that you want to see, so that you have a checklist when you're looking at a property, and maybe it's a diamond in the rough, or maybe it's something that you wouldn't have normally looked at, but you can see that it checked off all of those minimum requirements. It becomes much easier to thoughtfully put together an offer. Mm-hmm. Based on other factors. Does it need some updating? What's going to happen in the inspection? So just knowing what you want is the first place to start, besides the down payment.
Yes, having a budget on that note too. A lot of people have a budget and many don't prepare, and sometimes you go into something like Mary suggested where it might not be a house you would have anticipated buying, mm-hmm. but maybe it is. Maybe you do have to go over budget because you just can't live without it. This home is $50,000 more than you thought you were going to spend, so what do you do in that case? So having a budget with a little bit of leeway or latitude one way or another is certainly helpful. And maybe if you go over on the purchase price, you have to take from something else. Another thing that I wanted to touch upon is thinking of going back to the mortgage rates. Like Mary said, what we're seeing right now, is a little bit on the high side, but is much closer to the long-term normal, right?
When we came out of college, this is the rate that was available, was between 5.5% and 7.5%. That was the rate based on your credit.
That's right. That's
and we've both been out of college for a while.
Don't date us, Mary. She's lying.
She's normal.
But with mortgage rates stabilizing slightly, and there is a small chance that we might see subtle pullbacks, nothing drastic as she suggested, going back a year or two plus. This will help with the supply. We're up here in Rhode Island, we're up in the Northeast, so for all of you buyers, the market here, although it has slowed down a little bit and we aren't seeing so much overbidding or properties yanked off the market overnight as we were previously, it's still a modest supply and there still is a demand. Now in other areas like Florida or out west, we are seeing more supply. They are seeing more short sales, out in California and in the west. Down in Florida, some settling of the prices. So if anybody's looking in any of those parts, certainly they might feel a little bit more relief. Mm-hmm. Let's see.
Well, I see some opportunities coming up on inventory this year. And the first one that's front of everybody's mind this week with all of the executive orders and corporate policies being implemented is the return to office policy. AT&T is requiring it, JP Morgan, Amazon, they need more office space. So people are being forced back into the office. The federal workers are. And there are people that are working from home, and unfortunately there are people who took advantage of the Great Reset and relocated because they were able to work remotely. They are going to be forced to make a decision, a business decision for themselves. And if that involves retiring or leaving a job, the home that they have may be considered for sale. So I see an opportunity of more inventory coming on just based on that. Baby boomers choosing to downsize is an opportunity of more inventory coming into the market. And you had mentioned that that word short sale. We're seeing, as financial planners, we are seeing more people come to us that are in credit card distress.
Yes.
And there's definitely a limit to how much debt you can be carrying and your ability to refinance. And once you cross that point, the short sale is the only option unless you can get a quick sale and move on. So
that's right. It is hard to dig out of that ditch once you have that amount of debt. So we'll take another couple of minutes to expand upon short sales. And for those of you who might not be familiar with what a short sale is, it's pretty much the end point where a seller lets a property go for whatever the mortgage payoff amount is, sort of the last straw before giving up the property entirely and ending up in a foreclosure situation. Again, we are seeing a little bit more of this trend out west, and some of the reasons why, if Mary, you might want to touch upon why we're seeing or might be seeing more short sales than we were in the last year or two.
Very simply, the cost of living has increased so much, particularly on families that have, relatively fixed incomes. And by that I mean they're not earning commissions, they're not getting serious, wage bumps, that their income is pretty stable. And they've had to go to credit cards because of the cost of groceries and the cost of utilities and everything just costing more. So this is not irresponsibility. It's that we've had a number of people coming to us for the past 2 years that have said, oh my God, this credit card balance has gotten out. Like suddenly they look at it and it's $20,000, $30,000, $40,000. That's one thing if you're in a figure earning bracket and you're able to make some corrections or you're able to reach into resources and pay that off and clean the slate. It's a whole other thing if you don't have those resources. And so short sales come about when people have overextended themselves through a variety of borrowing. This can be having 2 car payments. We're seeing homeowners insurance is skyrocketing out of control. People are experiencing 20% premium increases. I know I did personally with no claims. So the poor people in Florida, and we haven't even gotten to California yet.
Even doubling in some cases.
So the cost of everything has been escalating. People have had to go to borrowing, and they're out of options. So short sale is the last train stop before foreclosure and bankruptcy. That's it. And so if you're speaking with an attorney, your lender, a CPA, this is not something that happens overnight. The bank has to consent to doing it. They have to look at your ability to get out of it, and that's why they require you to have PMI. That PMI, the primary mortgage insurance, is going to come in. That's that 20% gap between what you borrowed and what the house is worth. And the bank will agree to allow the house to be sold and basically discharge that delta, and you're able to pay off your bills and walk away. Sometimes you'll walk away with a small check. You will also walk away with what's called a 1099-C, and you are responsible to pay for the taxes on the amount that they discharged because it is considered a form of income.
Right.
So it is not something to be entered into lightly, but if your advisors are suggesting that this is an option, you need to pull the emotion out of it and sit down and really listen to what they have to say to you, because foreclosure and bankruptcy is far worse than short sale.
Very true. Very true.
And some people can get out of a bad situation by leveraging this. And there's a reason why it's called bankruptcy protection. It is a protective act.
It is. True. Okay. Well, I guess it's ironic because we hear so much of a positive outlook still going into 2025 from realtors. I have a great friend, Renato De Lima from Remax Innovations here in Rhode Island, and he's shed a lot of light on statistics and data from last year flowing into this year. And again, although we happen to be in the Northeast where our properties are in high demand, and I guess we're fortunate as a result, so we don't expect our values to move much, but we hit historic lows in 2024 around the country with about 2.5% turnover in home sales total, which is very low compared to what we were saying previously, right? But I think some people have come to their senses and realized, okay, things are changing. We'll talk about the crypto in a minute. Things are changing. The rates are now higher. Yes, some of us drastically overpaid for our homes when the rates were low. Just to give us a segue in, many of us were working from home. Okay, now we might have to go back to work. Maybe we're not spending as much time at home. We didn't need all that extra space. We don't need the gym there. The kids are moving out. We really shouldn't have built that pool. So we're seeing a lot of that, and I don't know, where it's going to lead to, but
well, and I think it's important to remember why prices escalated the way that they did. And it's because when the pandemic hit, there were a lot of folks who had the financial mobility to be able to make a significant change. So in southern New England, we experienced a lot of people from New York relocating, leaving the city because it was a hot zone, it was dangerous. So there's been this great reset. And there was some insanity for a while where people were paying way over asking price for property. And that was very frustrating for people trying to enter. They knew what their price point was. They were shopping at it. They were being responsible. And there's people just throwing money around like rock stars. And there's been a lot of buyer's remorse too, where you're in this house and you've overpaid. The bank is still only going to lend you 80% of what they say the fair market value is, considering an appraisal, the value of the house. So there are people that threw money in. Fortunately, the stock market is on a sugar high right now. So again, folks have the ability to go ahead and take the paper loss and make an adjustment. That's a best case scenario.
It's a best case scenario.
And then there's the folks in this great reset, because I don't believe that we're through it all yet, especially with this return to work order, that now are ready to sell their house, because it's a very emotional thing. And it's, if you can be practical and be unemotional about a property and think about it as it is an asset that can sink you or elevate you, and be very practical and almost cold about it, it's easier to make buying and selling decisions versus, all right, I'm going to finally sell the house, and guess what? Now it's on the market for 6+ months and you're not getting anywhere near what you thought it was worth because others were selling so far above asking price. That was last year. You
do have to take the emotion out of it. That's a great point. If you can take the emotion out of the process and be practical and just think dollars and cents, it will help the decision-making process. And to a lot of our viewers here, which could be a younger demographic, especially the YouTube folks, what is happening now might present a better opportunity for buying. So if you have prepared yourself and put some money on the side and have waited through the craze the last couple of years, this can be your time. Just keep in mind that you're not going to get those ultra low mortgage rates, as we've already touched upon several times. So be prepared that this is going to be your rate range, maybe 6 and change, 7 change. But with the home prices stabilizing a bit, you might have a little bit more negotiation power in the ability to finally dive in and make a commitment that you've been waiting to make.
And not only that, the rate is temporary, because you can buy in now at this rate and you can refinance again as soon as rates adjust, or as soon as there's enough equity in the property that you can go ahead and refinance it. It'll be a longer term maybe, but you're able to continue to increase your spending power.
See, that's always been my view. I've always found that it's better to, purchase the home at a, reasonable price, even if it's slightly overpriced, and, get in with a comfortable interest rate, knowing that at some point you will be able to refinance, especially if we're talking 10, 20 plus years down the line. And it blew my mind at how many people overspent, knowing that they would likely be underwater, once the dust settled.
What you can rent it for at the end of the day.
That's right. Rent
and
it
those
for
of us
or
that
sell.
live through the banking crisis, remember that the house is only worth what somebody's willing to pay for
That's it, exactly.
or rent it for.
Especially when you get to certain price levels. There are only so many buyers for homes at that level, and that was something that was not considered. And to your point, with a lot of people moving out of the cities like New York, I have a lot of clients in Fairfield County, Connecticut, who are doing the same. A lot of people wanted to head south and enjoy sunny, warm Florida. You know, this is where we experience the hype in a lot of these areas.
Well, and I'm experiencing those folks wanting to come back and reverse the decision. I have a number of people that moved to Florida, South Carolina. Some have adjusted well, and some are saying, you know what, the kids and grandkids are still here. I miss them. I want to come back. And maintaining two houses is not financially feasible for everybody.
Exactly. We kind of talked a little about sellers in the thick of that.
I could go deep into it.
Okay.
So with sellers, I see the biggest Achilles heel is emotion. And we see this whether somebody's not paying their taxes for a number of, they just choose not to file, it's depression. And choosing not to sell becomes emotional, and there's a couple of circumstances that this emotion plays into, and we study behavioral finance a lot, because if we can anticipate how our emotion is going to undermine us and head check ourselves, then we make better decisions.
True.
We have better outcomes. So the first one is kids. If you have kids in school, you don't want to disrupt them. But you have to look at economically what the consequences could be of staying in a house too long. That you have to consider all of the factors in it. I'm not going to ad nauseum this stuff, but you know what I'm talking about. If the market is shifting, you can't afford to live there. You're trying to provide a lifestyle that is unrealistic. This would be an example of divorce. Sometimes, we see this a lot. And I'm going to say particularly with women, if they had little decision making and handling of the marital finances and they end up with the house and the kids, they're extremely unprepared and unrealistic about what it costs to be there.
True.
And they stay in it too long, and we experience them cashing out at a disadvantage. They're walking away with maybe $30,000 versus they could have walked out with a couple of $100,000
Seen that happen
and
so
gotten
much.
a reset. And we see it all the time. It's about not being rational and unemotional about your circumstances have changed. So if you've gone through this, it's good to sit down with a planner, with a CPA, and have a reality check on this, because it only hurts you and by extension it hurts the kids. The second thing is age, third thing would be age. And when you're aging in a house that has bedrooms on the second floor, particularly if there's only one bathroom or the bathrooms are only on the second floor, laundry in the basement, property maintenance is becoming too much. People stay in it too long because they're emotionally tied to it. Maybe their kids aren't being supportive enough in facilitating the conversations and giving emotional permission to sell the house, and the house begins to waste. And wasting is a legal term, meaning things are going south because they're not being maintained and kept up, and so the value of the house is wasting, and that's less resource to be used to support living and longer-term care expenses and inflation.
It's true. I do see that happening a lot with elderly clients of ours, unfortunately, where it's not practical and the writing is right there on the wall, and what they should do you think would be obvious, but they're so emotionally attached and have so memory. And they are. Well, that's a life-changing event.
Particularly widows that are forced, they're now in a position, they're the only one to make the decision, and they don't have adult children pushing them supportively healthy along to make the decision. They're afraid, and out of fear they do nothing, and doing nothing sometimes is the most
costly
option. Yeah.
Detrimental.
Yeah, procrastination costs.
So we've talked about different types of sellers, elderly, widows, young families with children where school systems might be a factor, parents' commutes might be a factor. We also have seen a lot of millennials who have either bound together to purchase properties or have just purchased them on their own, and that might have been due to some windfall gains from their crypto investments or other investments where they did just get lucky and took a nice ride, were able to strip out some of those
before
gains.
anybody knew what it was.
That too. Any of those hot tickets where you could close your eyes and throw the dart and whatever investment it landed on, you made money. So a lot of those folks are now thinking a little bit more wisely and likely having to sell their homes, especially if they are single or just bought with a partner or a friend.
But if it was their first experience in owning a home, now they have the experience of responsibility, right?
Absolutely.
Because owning a house,
teach some of those good lessons.
There's tremendous responsibility that comes with owning a home.
You don't realize it when you're renting.
No, you have no idea until you do. It's like having a child. And you're responsible legally for a lot, and financially and physically, the maintenance. It's a lot of responsibility.
That almost comes back to setting a budget and consulting with a professional who can guide. It's not just the mortgage. It's not just the mortgage and taxes. It's all of the upkeep. It's all of the little ancillary monthly recurring bills or quarterly or seasonal that a lot of folks fail to put together prior to making these decisions that they now simply can't sustain with their incomes.
And I would go back to say it's okay to change your mind.
It is.
Recalculating. I think that buying a home, you should plan to be living in it, at least with the best of intention that you're going to live in that home for 5 to 7 years. If you do, you should at minimum break even if you step out of it, between the tax deductions that you're entitled to receive, between the realtor commissions that are paid, the equity that should be built up, plus you're going to sell it again, likely using a realtor in most cases and paying another commission. It's okay, but you should plan to be there for 5 to 7 years. If life forces you back into the office and you need to sell, then you need to sell. So it might be in your favor, it might not be. Again, if you're selling lower, then hopefully you're buying lower somewhere else.
That would be ideal. That would be ideal.
You know, something else for buyers, if you're frustrated and you're putting in offers and your offers are not being accepted or you're not making it through the inspection period, I would strongly encourage you to request that you be submitted as a backup offer. Because sometimes people get to inspection. I mean, a year, 2 years ago, people were buying houses really since
without inspection.
Since 2020, they were buying houses over asking price, no inspection. They're in there, and now they realize that maybe that wasn't the best option for them. Folks that are going through, they're requiring inspections now for the most part. I think that those days are pretty far behind us at this point, unless it's a coastal property. And even then, those folks, they're going to request an inspection. They might get there and not come to an agreement with the homeowners. Now the homeowners know, the sellers, that their property isn't perfect. They have a period to digest this news, this reality, and either remediate what was on the inspection list or put it back on the market, maybe with an adjustment in price. So by being a backup offer, continue to follow up, ask how the process is going. People change their minds all the time.
Do.
Plus, right now, if you've been ordered back into the office and you have an offer pending, you might be reversing it. Keep in touch with lenders and find out what's going on, because they will go and they'll close out a mortgage and say job change. And that's it. The loan is off and the deal is closed, and the buyer gets their deposit back in those cases. Lenders are very familiar with this process, so don't lose faith, but knowing what it is that you want and being realistic and diligent will certainly get you where you want to be.
That's a great point.
Prediction for what we think is, do we think it's going to be a buyer or seller's market in 2025?
I think it's going to be more of a buyer's market, notably more buyer market than seller's market.
I think so as well. I think so as well, just with the way things are trending.
More inventory, for sure. More inventory. It'll be
less
interesting.
Hype.
Yep, it'll be interesting to see what happens. We have a new administration in office, a lot of executive orders being issued, a lot of corporations changing policy. Stay tuned. I think you're going to see a lot more opportunities that weren't on the table a week ago.
Agreed. You might be pleasantly surprised.